All right, at the top of the hour, we told you how bank bonds may be worth avoiding. Well, for more on the corporate credit market and banks, we're joined by Leland Hart, portfolio manager of the BlackRock floating rate income fund. He's head of the bank loan group, where he oversees more than $11 billion in bank loan portfolios. And Leland, great to have you on again here on In the Loop. Let me ask you a question. Do you think the credit markets are overreacting? And I'm talking specifically about credit default swap spreads, right? Bank of America spreads hit a record last week. Don't seem to be coming in anytime soon.
CDS has moved a lot, certainly, but I think the whole world is resetting its economic growth and also thinking about the stability of the financial system. So is it overreacting? Usually markets tend to do that, but in this specific case, it's tough to tell. I don't think we're out of the woods on a global basis yet, so I think time will tell.
What do you think about the banking sector overall? I mean, we were going through some of the 13F filings the other day, and we saw a number of big names unloading bank stocks. Certainly the credit default market, which we just mentioned, indicates that the financial health of these companies is not as strong, or the perception is that it's not as strong. What changes in that sector to indicate that to you as an investor that it's time to load up on positions?
Well, it's a very good question. I think it's a question everyone's asking. The markets are both in flux, both the equity market, which is obvious, and as you're pointing out, the debt market, especially today, has moved around a lot. I think stability. When the global financial markets are moving around, volatility tends not to be good for the financial system, nor the lenders or investors, which are the banks. So a couple more days of stability would be great, sort of the opposite of last week, for instance.
What's the biggest concern right now? Is it what's happening in Europe as it relates to the Eurozone countries and the euro itself and the notion of a euro bond, or is it the slowdown in both UK as well as Eurozone economies and here in the US?
Can I answer both?
Yeah, absolutely. You can rank them for me.
I think it's 1A and 1B. Both are important. I think most people here in the US clearly have got an understanding of what's happening here, both with either the reduction in debt or just the slowdown in GDP, but nonetheless, Europe is still yet to be determined, right? We had big meetings yesterday between Germany and France, and people still aren't sure how they're going to get out of the near-term problem, and then again, what are the long-term growth prospects? So I think, again, time will tell on that one, but the work's being done, but no one's concluded anything.
And then, is there value out there right now as you look around? I mean, there seem to be, spreads have widened out quite a bit when we look at the credit markets. Is there some good value there?
Sure. I would say for what I look at specifically within the leveraged finance market, I would say based on equity volatility, the leveraged finance markets, meaning leveraged loans and high-yield bonds, have moved in sympathy with equity, certainly reflecting a slower growth economy. And that's something we've talked about before. In addition, you also have the fact that our federal government said rates will be low for an extended period of time, so your return from a duration perspective is also going to be compressed. So that being said, and when you bake into account where prices are today for loans and bonds, they've moved quite a bit since we spoke last, between 6 and 8 points respectively. So when you think about where spreads are on a historic basis, when you think about the growth outlook, you're getting paid for that risk, and they've almost overcompensated. From a medium and long-term perspective, it looks like you're seeing some great values. That being said, we're still in a volatile period, and on a day-to-day basis, you come on your show every morning wondering what's going to happen today. You're seeing a lot of new stuff that wasn't necessarily in people's playbooks. We're
looking at spreads right now, though, that are near where we were back during the worst of the financial crisis, right? During 2009, September 2009. It doesn't seem like we are in that bad a situation, though, at least from a credit balance sheet angle. From
the average corporate company that you're seeing today, their cash on hand is higher, their earnings are higher. They're actually much more efficient than they were in, say, 2006 and 2007, when it felt like we were running on all cylinders. And if you think about it, look at the diversion between corporate earnings, which you're reporting on today, which have been pretty decent, versus the prospects for GDP as a whole, which have been taken down. So sort of the U.S. corporates are in great shape. While GDP might be a concern, we're in a very different spot than we were from a sort of cushion perspective versus 2006 and 2007.
All right, Leland, we have to leave it there. Appreciate you joining us this morning. Always appreciate your insight. That was BlackRock's Leland Hart.